morning, everyone, and welcome to our storage design modeling working group for Uplift, Deb, and mixed fuel and distribution level resources. My name is Brenda Marquez on behalf of the Stakeholder Affairs at the California ISO. We welcome you today for March 16, 2026 meeting from 9 to noon. We will be going over a few items before we get started, as this call is being recorded for informational and community purposes only, and will be available on the CAISO website on the initiative page for storage design and modeling. So any related transcriptions should not be reprinted without the ISO's permission, and this meeting is structured to stimulate open dialogue and engage different perspectives. The facilitator will be providing guidance for comments and questions to ensure a productive flow, so please keep remarks sufficient and avoid revisiting points that have been already covered to allow space for all voices. Closed captioning and the transparency viewer are available on the bottom screen of your WebEx. If you have any questions, feel free to send me a message for finding those. To ask a question, please state your full name and affiliation before making your comments. I'll be reminding folks in case they do forget, but when unmuted, you'll have a pause about 2 seconds before speaking to ensure your audio connects clearly, and then you can also state your full name and affiliation at that point. If you're connected through audio through the computer, use the call me option located in your bottom screen, but if you're only connected through phone line, use *3 to be connected to the raise hand queue. You may see all the questions be sent to all panelists. Please include your affiliation as well. If you do experience any technical issues, myself or Tegan will be here to help and in terms of helping you unmute or getting your audio checked out, or we can also answer questions via chat. And then I think at this point, we do have the CAISO Policy Initiative Stakeholder Process that we launched a few months ago. This showcases a little bit of where we're at in terms of the scope and development phase of the storage and design modeling. We're currently within these two areas of scope and development. Sergio will be covering a little bit more where we're at, especially because we have other topics that we're also discussing within this initiative that are also working on towards the development phase. So we'll be reviewing that as well, and also invite folks to also check out the storage design modeling page for the information that we've already discussed previous. There's a lot of links, and I'll be putting them on the chat in case folks are able to just navigate quickly and put that on side. And we did just update the presentation this morning. So if you are seeing the version from last Friday, we invite you to look at the new one, and I'll be posting that here as well so we can follow along together. And at this time, I would like to introduce Sergio Duenas-Melendez for our storage design modeling manager. He'll be reviewing the following topics, and Dinesh will be joining us later on. Thank you.
Thank you, Brenda. Can I move the slides on my own now with the WebEx? Just want to confirm. Does this move the slide for everyone?
Yes, you did move. Thank you.
Okay, perfect. I just saw you are now the presenter. Excellent. Well, good morning, everyone. Happy Monday. I hope you are all enjoying the southern spring weather. Today we'll be focusing on the topics with the green boxes here. We'll talk about default energy bid modifications for energy storage resources in the morning, a topic that we've heard from our stakeholder community that it would be valuable to prioritize. And then a little bit later, we'll have my colleague Dinesh covering the mixed fuel paper that went out a couple days ago. We do have a lot to cover today, so we'll try to be very disciplined with time. And for that, that takes us, the presenters, to be efficient. It'll also take our questions and comments to be succinct and ideally minimize repetition. We gladly will welcome all of your comments in a written manner following this meeting, but we want to make sure that we can get through all of our material today. So as I mentioned, in the first half of the meeting, I'll be covering different topics related to default energy bid enhancements for storage resources. We'll talk about the consideration of developing a dev option for storage resources that are part of only of the Western Energy Imbalance Market. Then we'll talk about a couple of alternatives to develop a time of day dev for storage, where I'll be joined by my colleague, Mihir Shah. And afterwards, we'll talk about the reference level change requests and how that works with storage resources and some of our thoughts based on the comments from stakeholders. Later on, I'll pass it on to my colleague Dinesh, who will cover the topics included in the mixed fuels paper that we posted some days ago. And again, we'll welcome your questions, clarifying questions or comments, and all of this will be part of the comment template that will be due 2 weeks from now. So let's get started. Given the agenda we have today, I'll prioritize stopping for questions and comments at the end of sections or when there's a natural pause for any clarifying questions. So please raise your hand and bear with us as we go through the material so that we can attack all of this in an efficient manner. So the first section has to do with comments we got on devs. As we talked about in our prior meeting, we got a significant share of stakeholders urging the ISO to tackle the matters related to the default energy bids ahead of tackling other matters, particularly uplift. When we published our paper, we got 13 stakeholders commenting on our problem statement and guiding principles, and the vast majority of stakeholders supported or supported with some caveats. I want to go into the 3 caveats we heard from the stakeholders verbally here. So the first one has to do with, yes, support, but let's refrain from making perfect the enemy of good. Effectively, let's focus on achievable, implementable near-term enhancements as opposed to trying to develop a perfect method from the get-go that might delay enhancements. The second caveat we heard was, yes, support, but please also consider the potential for storage to leverage the reference level change request, something that we'll see later in the presentation. And the final caveat was somewhat similar, I'd say. It was, yes, support, but also consider including kind of the challenges related to developing WEIM-only dev in their proper context. This stakeholder mentioned that while it is important to definitely enhance the storage depth for CAISO EDAM entities, maybe it is not as crucial or timely at this moment to develop a readily available WEIM depth. So those were the 3 caveats we heard. Then on the area of opposition, one stakeholder framed their comments as opposition, but very similar caveats or recommendations to what we've heard. Instead, focus on the reference level change request, consider alternatives based on the devs applicable to other technologies, for example, hydro, and including the problem statement and guiding principles that we should seek to have a dev that minimizes the risk of charging site mitigation. So if we dig a little bit deeper, we see that 12 stakeholders submitted comments on the specific concepts discussed in the paper around dev enhancements for storage. again, a majority supported further exploring the time of day DEB concept, basically allowing for the calculation of more than one default energy bit to be used in real time so as to capture evolving conditions. Three of them, similarly to the prior comments, supported consideration of either the reference level change request or brand new storage default energy bit paradigm that is based on the hydro DEB. And two, didn't take a position on any of the alternatives included in the paper. So again, here you can see, vast support for let's move forward with the guiding principles, maybe tweak a bit to also consider charging mitigation. Let's move forward with thinking about time of day concepts while also talking about how storage might fit into the reference level change request. So based on all of this feedback, what we're going to do today is we're going to start moving towards, prioritizing these DEB improvements consistent with the feedback we've gotten since our December paper came out. And today we'll discuss a couple of alternatives to develop a time of day DEB. We're putting forth two different concepts to get reactions from stakeholders to present kind of the different philosophies behind them and how they might work and look. So we'll really appreciate your feedback. We want to discuss the value and framework of developing a DEB option for WEIM-only storage, mainly to address some of the caveats and clarify the ISO's position, given some of the feedback we've received. And today we'll also talk about the reference level change request and storage and the ISO's current perspective on it. And moving forward, we'll revise the problem statement guiding principles to incorporate this notion of minimizing charging site mitigation. And we'll further discuss and evaluate the potential merits of pivoting from our DEB methodology towards an alternative based on the DEB of other assets. This is really kind of to contextualize the discussions we'll have today. We have about 3 minutes if there's any comments or questions here. And so I invite you all to raise your hand if you have any comments or questions. And if not, we'll get going in the material today and start talking about the value and framework for developing a DEB for WEIM-only assets, storage assets. So I'll give it a moment or so to see if there's any questions, and if not, we'll get going. Okay. I am not seeing any at this time.
Yes, that's correct.
So,
thank you.
Perfect. I think we can get going. As I go through this next section, it would be really valuable, Brenda, if you could promote Mihir Shah to panelist for an upcoming set of slides. I see him as one of the attendees. Thank you. Okay, well, let's get going with this first piece. As I mentioned before, some of the comments that we got, the majority of the comments that we got following the updated discussion and issue paper we posted at the end of last year, that that there is value in considering having a readily available default energy bid methodology for WEIM-only storage assets. This is important because today these resources cannot, take a methodology off the shelf really from our DEB options, because the storage DEB is based on inputs. Their inputs are based on outputs of the day-ahead market processes. So as a result, all of these WEIM-only storage assets must go through the negotiated DEB process. In the comments, we saw that the vast majority of stakeholders agreed with, the value of developing a new DEB that can be leveraged easily by these assets. But some stakeholders, in particular two, noted a couple of concerns or considerations that make it so that this issue might not be a top priority in their eyes. The first one was that, not all storage resources face the same market conditions and risks. So in this situation, for example, a WEAM-only storage asset does not face the must-offer obligation requirements of, for example, RA resource that is internal to the CAISO VA. It also does not necessarily face the same financial risks related to having a financially binding day-ahead schedule. So in that context, the stakeholders argued if we are to prioritize something here, this might not be a top priority. And in a similar vein, they've noted that it wouldn't be valuable necessarily to have a single method for all storage resources, regardless of location, that might not be desirable or achievable. So because of these comments, we wanted to kind of clarify a little bit what we're thinking of here. And the key thing here is, we see significant value in development, but we want to make clear that this would not be, let's say, a single dev option. This is to address this comment on having a single method might not be desirable or achievable. What we're really thinking about is we'll have the storage that we have for WEAM-only storage, and that way, these new resources that are WEAM-only can easily, pick that option, and that will minimize the challenges associated with going through the negotiated debt process. So we want to make it very clear that this does not intend to supplant the current storage dev so that the new version is readily applicable for all of these assets, but more so it's intended to make sure that we have an option that can be used off the shelf by WEAM-only storage. We see a lot of value in developing a readily available dev for these resources for two reasons, really. The first one is that the proliferation of the resources across the West has been significant. We are seeing growth that is, similar in its pace as within the CAISO VA, but obviously really going from very little capacity to gigawatts of capacity quite quickly. And we also are quite aware of the administrative burden that the negotiated process places on participants, the ISO, and the Department of Market Monitoring. So given the fact that these resources are just becoming more and more popular, and that currently going through the negotiated debt process it really puts a burden on all parties of this situation, we think it would be valuable to just have a readily available option. Today, as I mentioned, all of these WEAM-only storage resources have a negotiated dev, and from our understanding, the vast majority of these negotiated devs are based very much on the real-time market storage dev, that formulation that we use for resources internal to the ISO VA and EDAM in the future. The key difference is that this methodology, the negotiated dev methodology today, leverages the default generation aggregator point prices to calculate the energy and price-based opportunity cost components. So this is an important difference, right? Because for resources that are internal, we use the day-ahead, pricing results. Here, this method uses the DGAP prices to be able to kind of assess and include those variables of energy cost and price-based opportunity costs. Importantly, these prices they're not binding, they're not used in settlements, but we are really using them, we're leveraging them as a forecast of real-time prices in that relevant balancing area. So this allows us to basically take the skeleton, the formulation of the current implementation for assets internal to the CAISO BA or EDAM in the future, while using the DGAP prices that are a viable forecast for that relevant BA. So at this point, we think that kind of trying to replicate this negotiated DEB methodology that is already applied to the vast majority of the negotiated DEBs is something that is feasible, is something that we could implement so that it's calculated as a readily available option. We know that the information related to this process is available within the relevant systems, and we continue to believe that leveraging these DGAP prices is appropriate, and it's largely consistent with what existing assets the vast majority already have in their negotiated DEBs. Something that I do want to note is that while these DGAP values are hourly, the way that we are calculating the negotiated DEBs today, and that we would, under this approach, would continue to result in static DEBs throughout the trade date. So this could be more so an initial step that could then later be enhanced by leveraging a time of day concept as the ones that we'll discuss in the next section of the presentation. So in the next section of the presentations, we'll talk about two different time of day concepts. And as a quick spoiler, it really is the second one, approach B or example B that we'll call, that could be perhaps easier to layer on this, so that we can also make sure that this WEIM only DEB is better reflective of changing conditions. So in closing, what we want to really state here is we agree with the majority of stakeholders that see value in this. We want to restate and clarify that we view it as developing a new DEB for WEIM only resources. And we also want to note that this option can be further improved with a time of day concept, as we'll discuss later. But very importantly, developing a readily available option for DEBs for WEIM only storage would not eliminate the ability of market participants to pursue a negotiated DEB. What it would do is it would offer a readily available option. It would reduce administrative burden associated with new negotiated DEBs, so reduce the administrative burden for new resources coming online. And it would also allow market participants to include these new options as part of their ranking of their DEB preferences. So we see a lot of value here, and we don't believe that this is necessarily in conflict with further enhancing the storage DEB applicable to internal resources to the CAISO BA. Okay, I'll pause here for questions. Based on the time, I think we have about 5-7 minutes for questions. So let's go with Alva, please.
Good morning. Can you hear me, Sergio?
Yes, Alva.
Great. This is Alva Swoboda, PG&E. Just a request. I mean, you've given a lot of empirical plausibility here, and I'm not sure it's even your job, but I do think that either DMM or Guillermo should provide some evidence that using the day-ahead DGAP is a reasonable forecast of essentially the 4 highest hours is kind of that approach. I mean, we don't even have that actually for internal to the CAISO, but I think that kind of data would be useful just for us to know whether it's really a fairly poor forecast or whether it's a fairly good forecast. So thanks.
Thank you for that, Alva. Yes, I think that is something we can seek to share with all of you. I would add, Part of the beauty of some of the options around the time of day thinking for devs is that we can also, through that process, identify periods where we might see, larger differences between what is forecasted and what materializes, and be able to address also some of that inherent delta, right? So I
Absolutely.
definitely think that, we can look at that as it occurs today, but also leverage some of the time of day concept to be able to minimize that risk moving forward. So I appreciate that, Alba.
Very good. Thank you.
Okay. I'm not seeing other hands at this point. I'll give folks another 10, 15 seconds to decide if you all want to raise your hand. And not, we'll gladly move on to the next piece, which is really where most of the meat of the presentation is at. So I think that'll spur some conversation and reactions. Okay. Well, seeing none, I think we're better off if we keep going and we talk a little bit about the alternatives to develop a time of day dev. So in the comments, as I mentioned at the beginning of the call, we saw a significant share of stakeholders endorse consideration of this concept. From our perspective at this time, we believe that developing a time of day default energy bit can be achieved in two ways. Now, when I say this, I don't mean that these are the only two ways, that we've looked at all of the different alternatives and we've determined that these are the only ones that are viable, but we wanted to present different bookend cases of different philosophies here to be able to elicit some reaction and some of your feedback. And of course, we'll welcome in your comments any thoughts about A or B, but we will also welcome if there are alternatives within this framework that you think may warrant exploration. I think within some of the comments we saw, some of the stakeholders also mentioned maybe instead of having a value that varies across the day, we might just want an upper bound for the total of the day or something like that. And we think that, those options kind of exist in the in-between between A and B, right? So we wanted to present this kind of two different philosophies, two different approaches to be able to get some feedback and reaction and see if there's particular buy-in for one of the approaches over the other. So the first approach, example A, as we'll talk about it through the presentation, is really about calculating different values based on the current methodology and a rolling window for the inputs. So we would be applying the current methodology in a rolling basis within the given day so that the range of hours that is considered impacts the inputs, particularly for energy and opportunity costs. The other option, example B, is to create a single value, which is what we do today, and then simply have different multipliers across the day that are trying to capture those differences between day ahead and real-time prices. So this is looking more at a historical evaluation of that delta between day ahead and real-time prices. So as you can tell, example A and B follow different philosophies but achieve the goal of having a value that changes through the day. Under example A, the philosophy is really, let's focus on capturing difference across the day, but based on the same current inputs we use, So it's still kind of capturing the difference across the day, but relying on the outputs of the day-ahead market in the case of real-time devs. Example B, on the other hand, has a bit of a different philosophy, right? this philosophy is more focused on capturing the pricing differences between markets so that we can shape the real-time dev. So what we'll do now is I'll go through a more detailed walkthrough of what example A would look like. Then I'll pause for comments, clarifying questions. And then we'll talk a bit about what example B would look like. And I'll turn it over to my colleague Mihir to go over some analysis that he's performed to inform what different multipliers could look like based on the differences between this day ahead and real-time prices. Okay, so example A, different values based on the current methodology and with a rolling window for the inputs. So here in this slide, I'm sharing in the left side, you can see an LMP table. This is, not supposed to be the most representative day, but it is an interesting day. It's March or April kind of shape we see, particularly more earlier in March when we still have that bit of like a bimodal situation with LMPs rising early in the morning and then later, obviously, in the afternoon near the peak hours. Based on this LMP table, that is, where all of this is illustrative, based on this LMP table, we can calculate the depth today, as you can see in the second table. And under depth today, I included the different components that go into the depth. The energy cost that is already adjusted by an assumed efficiency of 90% and a duration of 4 hours. The variable storage operation cost, which here is assumed to be 10, and the price-based opportunity cost that is looking at the fourth highest hour, looking at this table on the left. So as we develop the depth today, it's important to note that the energy cost is already considering that duration and efficiency. It is assuming that the storage performs one cycle of charging and discharging per day, and that it will charge by continuously charging during the least expensive continuous block of time during the day. And that considers the inefficiency of the asset. Very, very important. This will come back in a couple of slides. So this is very important because it assumes that the resource will charge during the least expensive continuous block of time with that inefficiency. So for a 4-hour asset, that requires a 4.4-hour charge time. So this will come back when we think about splitting the days, splitting the day in different numbers of depths, right? Okay, so here we are going to start looking at what would it mean to have 2 depths per day under this methodology. So for the first depth, the one that would be applicable for hour ending 1 through hour ending 12, we're not changing anything. No. In this example, we are looking at every single hour of the day because we look at all of the hours within that first half and coming up. So you can see that the first depth of the day is the same as the single depth we have today. Now, when we go to the second half of the day, we are now only looking at the last 12 hours. And based on those last 12 hours, we are updating the energy and price-based opportunity cost. In this example, you can see that the main difference comes from that energy cost because now the 4.4 hours with the lowest cost are higher in cost than at the beginning of the day, right? They add up to a higher cost. And you can think of this as representing to the opportunity costs related to incremental dispatch, right? Incremental discharge. So basically, later in the day, being discharged incrementally means that you're now exposed to a higher energy cost if you want to make up that difference. So this is really kind of the philosophy of example A. So in the next slide, what I've done is I've used this paradigm to show what it would look like to have 2, 3, or more devs in a single day. So here we have 1, 2, 3, and 6 devs. In all of these, we are doing the exact same thing that we were doing in the prior slide. We're only moving the window of what LMPs and hours are considered given the period you're in and the hours remaining, right? Any hours that have already passed are no longer informing the dev. What you can see here is in the 2 and 3 that we wouldn't really have a huge difference until later in the day, but when we get to the 6 dev example, it's pretty clear why we keep seeing a rising dev until the end of the day. And it really is because this rolling window approach is preserving the assumption that we need to fully charge that storage within each period, which means that we would expect to have at least 4.4 hours, right? So this definitely affects the applicability of this methodology for the more periods we want, because once we get to like 6 periods here, it really is that very high opportunity cost that is setting, energy cost that is setting the dev in those last 8 and particularly last 4 hours. And because we need to count the inefficiency here, it really makes it so that this is not a fully viable method, even at the 6 range, right? And it doesn't capture necessarily the effectively that new risk of how incremental discharge may expose the assets for higher costs or different costs. So in the next example, we're doing the same methodology, but we're now scaling the energy costs to only consider the share that is remaining of the day. So if we scale the costs under this approach, and we focus on the 6 example, the 6 dev example, I think you can see more clearly that this approach does capture that we might want a higher dev at the beginning of the day to kind of protect for that earlier discharge prior to the morning peak. Then we want a bit of a lower dev up until the afternoon ramp and net peak really start kicking in. At that point, we get the highest dev, and then after we have those peak hours, we have the lowest dev of the day. So this is the same method. The only difference is that we are scaling the energy cost to the share of the day that remains. And that way we're limiting, that this variable is kind of the sole driver of the value. And here I've included kind of a walkthrough of how we're doing that scaling, no? So we're looking at that least expensive continuous block of LMPs for 4.4 hours times the remaining share of the day. If we take this example on the green circle for the 68.9 dev from hour ending 17 to 20, we would see that we're just adding hour ending 17 LMP, 18, 19, 20 LMP, and then a fraction of the 21 LMP. And all of that addition, we're then scaling by 8 out of 24 hours, which are the hours that are remaining. And that gives us an energy cost of 52.6, which, including consideration of the variable storage operation costs, would spit out this dev of 68.9. So I think overall, we think that this is a viable approach to be able to get different devs across the single trade date, but it does have some limitations, right? The first one is that it really, it requires first that we split the day equally or as close as equally as we can. If it's 2, 3, 4, 6 options, but still every fraction every share needs to have kind of its equal duration. It also continues to rely on the day-ahead outputs, right? So while we're getting a better sense intraday based on those outputs, it's not capturing the variance, the inherent variance between day-ahead outputs and real-time conditions. So here's where the value of B comes into play. Before I go into option B, I'd like to give folks, 10, 15 seconds to decide if they have any questions here or comments before we go to option B or example B. That's, but let's call it that.
I don't see any questions from my end. Thank you.
Okay, that sounds good. So I'll go on to talk about example B. And after I cover kind of the logic of it and how it would work, I'll pass it on to me here to talk about the analysis that could inform how we think about these multipliers. So example B, a completely different philosophy, right? In example B, we are looking at the output of the current depth formulation, and then we would create a set of multipliers that are based on the historical differences observed between day-ahead and real-time LMPs. So here I took the same LMP table we had, the same kind of depth today that we had in the prior examples, and on the right side, I've included this other table that includes a multiplier specific for different hours, right? At the beginning of the day, the first 5 hours, we have a bit of a higher multiplier than we have today. The multiplier today for every hour is 1.1, right? So in this hypothetical table that we've included only for illustrative purposes, you can see that at the beginning we have a bit of a higher multiplier. Then we have the lower, let's say, original multiplier from hour ending 6 through 9. Then as we start getting really a lot of solar, we have an even higher multiplier to prevent, incremental discharge or charge side mitigation in that period of the day. And then as we start having the afternoon ramp all the way through the peak, we have the multiplier we have today of 1.1. And at the end of the day, we again raise it a little bit to 1.15 so as to, preserve or value correctly the state of charge there ahead of the next morning's peak. So already in looking at this table, I think you can see that there is, the philosophy is different of like why the debt is changing through the day, but it's also more flexible, right? Under this approach, we don't necessarily need equal shares of the day to have a different multiplier, and we're able to think about this a little bit more in a targeted manner that is not necessarily burdened by the divisions of the day we've made. So once we take that multiplier that I had in the prior slide, you can see what this resources dev at the end would look like on the right side of the slide. You can see that basically by creating this, we're able to shape the real-time dev in a way that is more, it is capturing those differences that we derived the multiplier table from. And I think in the next slide already, we have kind of part of the analysis that we think will inform, your thinking, and we want to hear your feedback on how to understand and leverage this for the potential development of a multiplier by hour. So I'll pass it on to me here. Feel free to just let me know if you want to change the slide. Yeah.
That's good. Can you confirm you can hear me, Sergio?
I can hear you, but it's a bit faint, Mihir. If maybe we can get the mic closer.
Okay. Any better?
Yeah, way better. Thank you.
Okay, thank you. And thanks for the opportunity to speak on these slides. Yeah, Mihir Shah from the market analysis team. So stakeholders had requested some analysis on how real-time and day-ahead prices may diverge to inform the proposals regarding the storage debt. And we did that, and we've looked at the DLAP LMPs across the CAISO BAA, including all four DLAPs, PG&E, SoCal Edison, San Diego, and VEA. So I wanted to take some time to go over the analysis and our findings. We looked at the analysis across a one-year period, 2025, and we're comparing the 15-minute market, RTPD or FMM, DLAP LMPs, to the day-ahead IFM DLAP LMPs. This chart is showing the hourly profile across the day, and on the y-axis is the difference between the 15-minute and the day-ahead. Positive difference means that 15-minute is higher than day ahead. Negative difference means 15-minute is lower than day ahead. And so this chart is showing us that most of the differences are concentrated within a very small range. See that the size of the box, which represents more than half of the sample, is very much concentrated within almost a $10 range, plus or minus. However, there are not an insignificant number of situations where the real-time price exceeded the day-ahead LMP by much larger amounts, or it was lower than the IFM LMP by also large amounts, and those outliers really seem to be concentrated in these morning and evening net load ramping hours. So we wanted to be able to look a little bit more at some of the dynamics in the smaller range of price differences. And so if we can go to the next slide, this will help present this data in a different format. And so same data, but it's now broken up into ranges of prices so that we can kind of see more clearly within that smaller size of difference what's happening. So again, it's FMM minus day ahead LMPs, DLAP LMPs. This time the y-axis is a percentage. So it's showing the size of each of these bins that are shown in the legend. You can see that, for example, in our ending one, that's almost 90% or 95% or 85% of the data is concentrated within the plus or minus $10 difference. And that changes throughout the day. So there, it looks like on average, the FMM or 15-minute market LMPs were higher than IFM in about 25 to 50% of the time. And again, higher FMM prices means positive differences. So looking at the colors here, those positive differences are the yellow color and upwards on the chart, essentially. So you can see that it is ranging from about 25 to 50% of the time, 50% being in the middle of the day, around from hour ending 9, all the way to about hour ending 17, and then the rest of the hours, the percentage is slightly smaller, meaning the FMM prices were on average lower than the IFM prices. On the right side of this axis is showing the average hourly price difference, and that ranges is between $1 and $4 per megawatt hour. There are some hours where you see those outliers show up a little bit more. And so on the positive direction, that green color or the pink color, which is at the top of the chart, that's showing up in hours during the morning peak. So hour ending 8, we see that there. And then in the evening peak, we also see that there, hour ending 17, 18, 19, 20, and others. On the negative side, we're also seeing those outliers showing up in similar hours there on the dark blue and the orange color, which is at the bottom of the chart. I think
If
that's
I
all I
might
have
add
for
something
this.
really quick, here. I think what's very interesting too about this plot is that you can see it's really from the yellow bucket upwards that we are seeing like positive differences. So that definitely contributes to this range of being between -$4 and +$1. I just wanted to really underscore that for our participants here. Thank you.
Thank you. Okay, let's go to the next slide. I think this is the last slide, and then we can invite some questions. And so, we wanted to focus on the periods where the FMM price was higher than the IFM price. This is where the storage depth being based on day-ahead LMPs is when is that an underestimation of the real-time conditions, and this was primary reason for wanting to even look at this analysis. And so we saw that the positive price difference, meaning when FMM is higher than IFM, is occurring 25 to 50% of the time, at least in the sample of 2025. And when we dive into that, we see this is the same color scheme that we're seeing. So I've just removed all of the negative price bins, and we still have the same color scheme here. We can see that this helps us to inform there seems to be certain periods where we're having some similar trends. And so if I could talk through those, we seem to see from left to right, I'm just going to talk through that, and we seem to see how the average price difference, which is on the y-axis on the right side, is and those numbers are different because now this sample is just looking at positive price differences, so the average price difference is a minimum of 0. And we can see that from R ending 1 through about 5 we have the lowest average price difference, and then that sort of increases into that morning peak. You find a little peak right there, R ending 6, 7, 8, 9, and then you get into the middle of the day all the way until maybe R ending 15. Then there's another peak until R ending about 21, and then it sort of drops off again, R ending 22, 23, 24. And so this starts to inform maybe a potential trend or some more targeted hours in which we can address the storage depth and make it be more reflective of real-time conditions. And so this kind of, as what Sergio was saying before, is really getting to the example B. It's more relevant to example B, which was talking about differences between day-ahead and real-time prices, as opposed to example A, which is really mainly just talking about a rolling window and sort of capturing what's remaining throughout the day. So I think this is good, and I think I have some implications on the next slides. Maybe let's go to that, and then we can invite some questions. So to summarize this analysis, the 15-minute DLAP LMPs are higher than the day-ahead LMPs, about 25 to 50% of the time, looking at a 2025 sample. This is across CAISO. And what that means is maybe that the storage depth that is based on day-ahead LMPs may underestimate the real-time costs in that 25 to 50% of the time, but conversely, it may overestimate the real-time costs in the 50 to 75% of the time. And then the next slide, if we were to increase the storage depth, we saw from that previous slide, targeting specific hours of the day seems to be a approach that's supported by the data. And here I just give an attempt at breaking out or specifying what those hours would be and what the recommendations could be for those hours. So let me just go through it. We can start with the peaks that we saw on the chart, which are the morning ramp hours, 6 through 9, and the evening hours, 15 to 21, where the 15-minute DLAPs were higher than the FMM, than the day ahead by the largest amount, on average $10 to $12. In these hours, mitigation to a DEB based on the day ahead LMPs would result in discharging during those highest priced hours. That's not necessarily a undesired outcome. We want batteries to be able to capture those high prices. And so maybe there's no change to the DEB in those hours. Now, moving to the next block, the midday hours, earning 10 to 14, let's say, where the 15-minute DLAPs were higher than the day ahead, but by less, on average $8 to $10 per megawatt hour, where mitigation to that DEB that's based on a day ahead LMPs could result in discharging prematurely before we reach that evening peak that we want the batteries to be available for. And this is what the midday hours were, the lower priced hours. And so maybe to avoid that outcome, the DEB could be increased. And then finally, we have the ends, the early morning and the late night hours. For example, 1 to 5 and 22 to 24, where the price difference was the smallest. FMM DLAPs in that chart were on average $4 to $8 higher than IFM in the positive direction. And similar to the midday hours, we want to be able to limit the storage resources from prematurely discharging. And so increasing the depth. However, maybe the increase can be smaller because the batteries are already having a low state of charge from having discharged overnight or during the evening peak and don't need an opportunity to charge up. And so we want to incentivize charging rather than premature discharging, and we can increase the depth. And so I think that was my last slide, and I think at this point can invite some questions and Sergio as well. If there's anything else you'd like to add here.
Quickly before we go to the questions, I think something I wanted to add is that, we kind of took a bit of this slide to develop the example on slide 31. So when you take a look at that, you might want to think it through this lens too. And I would say another kind of merit or additional value I see on example B over example A is that it allows us to think about the value of the next day and incorporating the value of that state of charge for the next day via the multiplier without necessarily kind of revamping the calculation per se of the DEB, right? In the late hours, we are already kind of thinking similarly to how we would think at the beginning of the day, hour ending 22 through 24 and hour ending 1 through 5, we are seeing the value of, okay, that state of charge can be useful when we're meeting the next day's morning peak, which is something that is complex to capture under example A, because everything is just really focused on the outputs of that day ahead in that trade date. So I just wanted to underscore that before we go to the questions and the reactions. So let's get started with Alva, see while others think about their questions or thoughts. Thank you.
Hi, Sergio. Can you hear me?
Yes.
Good. Alva Svoboda, PG&E. I think so. The second option seems to offer more transparency to the bidder in the sense that they can ahead of time know what they're going to be mitigated to. But one question I had, because I'm probably off on this, it's sort of reflecting history that I'm not, I'm sort of forgetting the implications of. But the DEB multiplier, I'm equating it with the multiplier that's available to determine what you get mitigated to. But my impression was that multiplier was not applied to the bids if they were being inserted by CAISO. So essentially it was like a headroom parameter, and people could bid between, they could bid something below the 10% or whatever it was, and that, but they would know that that at most they could bid the 10% headroom and not get mitigated below that level, essentially, so they could protect a certain amount of headroom through that parameter. But this seems a different parameter altogether. Can you refresh my memory on this parameter versus was there a headroom parameter on the DEB? It's not just for storage. I thought this pertained to other resources as well. So I'm just a little confused about the nature of that parameter.
Yes. So I went back to slide 31. At the bottom of slide 31, we have the current storage DEB formulation. And in that formulation, you can see that we have this item at the end called the DEB multiplier. That is 110%. So if we go a little bit back to slide 30, you can see that here we have kept at least 1.1 as the multiplier for every hour, right? The only difference we've done is that in some hours, we've increased that multiplier to 1.15 or 1.2. So basically, this is that, let's say, quote, headroom multiplier that you mentioned. It basically, the difference is we're tweaking it in some hours where we know that historically there's been a higher difference between day-ahead and real-time LMPs, so that we can capture that additional buffer of error or delta, right? We're not adding a new one in this example. Of course, we welcome perspectives on that through your comments and others. We're merely just like working with this last element, the DEB multiplier, and adjusting it in different hours, adjusting it upwardly in different hours. Yeah.
Oh, okay, so I might, this is where I think I was just flat out wrong, but I was assuming there was a difference between the bid where you would be mitigated to versus the bid that would be inserted as a default if you had no bid in place. And you're saying here, because you're giving this as the calculated DEB, this would be the same in either case, essentially.
Yeah, this would be the DEB, but you know, under this example, right? This is not set in stone yet, so of course
right, well,
we
I mean,
obviously welcome feedback on that. Yeah.
But if you just make it 1.1 all day, this is essentially the current.
Yeah,
the current
exactly.
DEB. Yeah. Okay, thanks. I'm going to have to look back at history a little bit because I thought that there was that multiplier was more of a discretionary kind of, like I said, a headroom. It's not really headroom, is what you're saying. It's just the CAISO is applying the headroom essentially to the calculated cost. So, and again, just sort of my comment of comparing these two examples is just that this is a whatever, you know, as Neil here was pointing out, there's a little bit of a difficulty with conveying future value in this method, but on the other hand, it does offer a lot more predictability to bidders than the option A would in terms of what their bids would be mitigated to if they were bidding above that level. Thanks.
Yeah, I appreciate that, Alan. I would say predictability for market participants, but also adaptability of the framework itself, right? Because it would allow us to be able to take a look back and modify and adapt as needed as conditions change, right?
Right.
Okay, we have two more hands up. Let's address those and then move on to the next topic. So let's go Nicole and then Don.
This is Nicole Selling with DMM. Can you hear me okay?
Yes.
Okay, great. Yeah, I just kind of wanted to chime in here. So if I'm understanding these correctly, I don't think either of these DEB formulation options are really incorporating intraday opportunity costs. They're not really considering the value of not being available in the later hours. And you can see that in option A, where the highest DEB is in the peak hours. And then even looking at example B, the DEB patterns look a little bit more like they might be reflecting intraday opportunity costs, but they're not based on anything that actually reflects opportunity costs. They're just based on price differences between the day ahead and real time, which is seemingly just happens to line up with where we would imagine the intraday opportunity costs would be highest and lowest, which still not to a perfect degree. And so I think we'll have some comments about that and some concerns there, because while there might be some reason to have the DEB incorporate the fact that there's differences between day-ahead and real-time prices. Another big issue is that intraday opportunity cost variability, and I don't think that this design of this particular multiplier is going to be accurately incorporating those changing intraday opportunity costs because they're not looking out to future prices in outward intervals. Thanks.
Yeah, quick kind of reactions, Nicole. I'd say in the first example, in example A, what we are trying to do is update the intraday. Okay, we're trying to use the data that we already use today to calculate the DEV and kind of update the DEVs through the day to better reflect the energy costs that this resource might face and the opportunity, the price-based opportunity cost that the resource might face. So in this example, as we move through the day, let's go to this one that you have only two. No? In this example, as we move through the day, the PBOC, the price-based opportunity cost, hasn't changed, but it could. It just hasn't because of the LMP table we've included here. But like if we had a different one that in the second half, the four highest price is now not 41, but let's say 50, it would capture that. And the energy part is kind of capturing that evolving cost of incremental discharge later on, because now to make that back, you need to pay more, right? So the way we're thinking about it in example A is the whole day DEV is going to get stale at some point within real time, right? Because the hours that were relevant to calculate this 46.6 value already passed. If we have different calculations through the day, we can kind of update those inputs. So in that regard, it is seeking to capture that difference of like the outputs need to be the most relevant by the given period you're in. But I do get the, critique of like, well, in this scenario though, the driver is perhaps more so the energy, which is part of the costs, but not the price-based opportunity cost. And then in example B, I think kind of the idea that we want to float here is a little bit more high level than what this hypothetical table is showing, right? We're not trying to say with this example, we think these are the hours and we think these are the multipliers. We're more so trying to say, we think doing analysis to be able to update the multiplier at different times of day would have the value of us being able to better capture these differences and be informed by them. But of course, the specific hours and specific values, we definitely want feedback on that, and also on what analysis you believe would better inform them. So we look forward to those comments from the MM. Yeah. Let's go with Dawn. Yeah.
California Energy Storage Alliance. Can you hear me?
Could you repeat your intro, Don, please? Thank you.
Yeah, this is Don Trethewey from the California Energy Storage Alliance. Can you hear me?
Yeah.
Okay, great. Good morning. I just wanted to make one comment on this. I think with example B, you're trying to get at the real problem with the real-time default energy bid. The problem with the current real-time DEV is that it's based on day-ahead prices. And really what you want the real-time DEV to be based upon is the real-time opportunity cost that they're going to be, that storage resources are exposed to. And so I think, option B is trying to recognize that the IFM prices are probably not exactly right, but you're just applying a multiplier to them. And I think what it really comes down to, and I think I've made this comment before, is the correct storage DEV, the value of that is the price that puts storage in the correct position in the overall resource bid stack across the EDAM footprint. You know, that's what ensures that you don't, for instance, dispatch storage because gas is more expensive in the middle of the day and you need it, when you'd actually prefer to run the gas and keep the storage later. But you can only do that if you actually make sure that you put storage in the correct positioning of the bid stack. And I think that's where understanding what an estimate of what the real-time opportunity cost is what allows you to do that. And I also was doing a little history research, and I really recommend people read the Market Surveillance Committee opinion from September 9th, 2020 on the ESDR 4 initiative, which initiated the entire original sort of default energy bid. And I think there's a lot of concepts in there. I mean, it's a very well written and thought out opinion that I think we really should go back and reassess, because I think the MSC highlighted a lot of the concerns that we're seeing with the storage deb and foreshadowed those in their comments. And perhaps we'd be well served to read those again and see maybe if they actually now make more sense to us to go down the path that the MSC laid out in front of everybody. And I think the other thing too, I got on a little late, so I was surprised to see that there was comments that the EIM needed a specific default energy bid for storage. When, as I highlighted earlier, the problem with the current storage DEB is that it relies on day-ahead prices. So I would argue that whatever we come up for storage for EIM and for everybody else in the EDAM is really about how do we reflect that real-time opportunity cost. So in essence, it's not the fact that the WEAM doesn't have a day-ahead price that they can't use the standard storage DEB. It's that the standard storage DEB is flawed because it uses the day-ahead prices as the foundation for its calculation. And I think we need to be focused. That's why I think you can have the same for each one. And then one other comment on if we did have different DEBs for storage resources based upon if they're WEAM or EDAM. I think you need to think about that within the context of system market power, where groups could be put together in a group and where you might have EDAM BAs and non-EDAM BAs with different DEBs calculated for storage. I don't know. I don't think that could give you some anomalous results if we ever made the misguided decision to go down system market power for CAISO. But I really recommend people read through the Market Surveillance Committee opinion for 2020. Thanks.
Thank you, Don. I appreciate the comments. I think quick reactions before we move on to the next topic. I think one of the elements we heard loud and clear during our in the comments from stakeholders around enhancements to the DEB as well is, let's prioritize this and not make perfect the enemy of good too. So I think, we definitely will take a look, of course, at the materials you laid out, and I appreciate that. I also want to note, part of our thinking here is we want to make sure that the DEB for storage is, in a better place relative to where currently is at. And we've seen, tremendous interest with some of the comments around, let's think about this, looking at the current elements that we can work with, right? Like the multiplier, reassessing the calculation too. So we do welcome those comments, and I think for folks that look at example B and think, maybe we need different hours, maybe we need to pay attention at different analysis to inform those hours and those percentages. We greatly appreciate that in your feedback. Let me quickly check the chat. Okay, let's go on to the next topic, and thank you very much, Mihir, for your time and your analysis. We really appreciate it. We'll go on to the next topic, and I'll take questions on this next element at the end, and then I'll pass it on to my colleague Dinesh to cover the paper that we recently released. So as I mentioned at the beginning of the call, while most of the stakeholders supported this time of day concept, some argued for storage to be able to access the reference level change request process. Specifically, three stakeholders called this out in their comments. They argue that storage should be able to have equal rights to submit reference level change requests subject to ex-ante review, either automated or manual, and that this would allow them to, be able to modify or update the dev when intraday conditions are significantly different in real time, such that the dev is no longer a valid reflection of their expected opportunity costs. So a little bit of history of the last time we talked about the reference level change request for storage is that we talked about this 2024 in the initiative focused on bidding above the soft offer cap. At that time, we were really focused working with our market participants to ensure we could develop a solution that was implementable, achievable in that summer. So when this first was brought up, the ISO didn't further discuss the merits or pertinence of this option because we realized that it could not be achieved in the time frame that stakeholders were looking at. So really the discussion around storage and the reference level change request kind of began and ended in that initiative with this might be very complex. It cannot be done in such a quick time frame. So we really didn't go in depth into the applicability of such a process for storage. I want to start with a little bit of kind of a background and overview of the reference level change request process so that we can talk about how the ISO is thinking about it for storage currently. So today, this process is very narrowly defined. It is really focused on variable costs, and it's designed to be used infrequently and under extreme conditions, right? The idea behind the reference level change request is not something that we're doing or looking at leveraging every single day. It's really more so focused on variable costs where resources possess better or more accurate information about those costs. So, for example, for gas resources, the ISO, we might know about price in the indexes, but specific resources definitely have better information about their actual purchase price. For storage resources, on the other hand, these do not have commitment costs where, for example, it would be informed by other variable costs like their fuel. And their fuel costs are really energy, which is endogenous to the ISO's market. So we already here see kind of a difference between what storage and gas resources might know or be able to have better or more accurate information of. So today, the reference level change request process, we've really developed it to verify and or audit cost-based offers. This is also why it is a process that is intended to be used infrequently and under extreme conditions, because leveraging this process will create administrative burden to both the market participant and the ISO. But this process is needed because a cost-based offer should reflect a reasonable cost expectation based on a subset of costs that are reflected on market-based offers. So a cost-based offer is something that the ISO should be able to verify or audit, and reference levels are always based on this cost-based approach, so that we can make sure that those offers and updates to those reference levels are meeting that same standard. So this is, of course, kind of in a conversely or in contrast to market-based offers that really reflect the supplier's own valuation of or willingness to sell energy into the market. market-based offers are really seeking to reflect the supplier's unique risk tolerance and use preferences, and they're appropriate in a competitive setting because these bids and offers are usually tempered by competition, but they're kind of fundamentally different from the cost-based offers that we think of and that are really used in the reference level change request process. So for storage resources, we think that the key driver of updated costs would really be their energy costs, which are directly related to their fuel and opportunity costs. These energy costs are directly related to the energy market, right? They're not bilateral, and they're not the result of out-of-market actions, as opposed to gas, for example, right? A gas resource might, secure its fuel through bilateral contracts or through a market that is, distinct from the electricity market. So for a gas resource, these assets will have better information, better and more accurate information of this cost. But for storage resources, these are not similar to gas resources from the ISO's perspective. Storage resources do not have the same ability of gas resources to have better or more accurate information about their energy costs relative to the ISO. And as I mentioned before, the fact that these energy costs may connect to their opportunity costs, while it is important, it's also key to kind of differentiate between how those energy costs could impact their cost-based offer, which is something more related to, as close as their marginal cost of generation, whereas the opportunity cost is also related to, the supplier's own risk and use preference. So in this context, we do not believe currently that it would be reasonable for storage resources to leverage the reference level change request process. Sorry, that was an accident. We think really that gas resources are essentially different than the storage resources in the information they have and the ability for that information to be a better or more accurate representation of their costs. And since this is not necessarily since this is not the case for storage resources, we don't believe at this point that they should be able to leverage this reference level change request process. We believe that enhancements to the storage tab might be able, such as, for example, the example B we just talked about around the multipliers, they would be able to capture the differences on these energy costs through the day and represent it that way. But at this point, I think it will be valuable if I pause for questions before switching gears to our next topics. We have about 3 minutes for questions, so let's take 1 to 3 hands at most if people have any thoughts or feedback here. I'll give folks 10, 15 seconds to decide if you have any questions or thoughts. Of course, beyond your verbal feedback here, we'll always welcome your written feedback through our comments that we do a couple weeks from now.
So if anyone has an issue trying to raise your hand, it's on the bottom of your screen. So you'll see that little raise hand icon. But if you have any questions, let us know. Thank you. But I don't see any questions coming in.
Okay. I'm not seeing any questions at this point either. And let's see how we're doing on our agenda. We are about 5 minutes behind. So it'll be better if I pass it on to Dinesh. I'm going to go to this title screen here for you, Dinesh, and maybe if we can allow him to move the slides as the presenter, that would be great. Well, thank you. Thank you all for the time this morning, and we look forward to your comments. Go ahead, Dinesh. Thanks.
Hey, thank you, Sergio. Can you hear me okay?
Yes, we can, loud and clear.
Okay, great. Thank you so much. Good morning, everyone. Hope you all had a good discussion and, having a good time here. So just, for context, we had a paper that came out for the mixed fuel and distribution level resources topic group. It was the second paper of the topic group, and it was published on March 9th. So we have 4 topics from that paper to discuss today. The first one we'll do is the default energy bid for hybrid resources. It sort of builds off the conversation that we were having about default energy bids. So I think it would be good to just close out that topic here before we move to the others. Okay, great. So first off, this is an issue paper topic on hybrid default energy bids. And some background. So the ISO mitigates resource bids to cost-based DEBs to prevent the exercise of market power. Right? We've been talking about that for the last few minutes. And hybrid resources at this time have no standardized cost estimates. Right? So different technologies may have different cost structures, and there's no developed methodology for creating that cost estimate at this point in time. And therefore, since there's no cost estimate, there's also no default energy bid. Back in 2020, the ISO committed to monitoring in the meantime, but also stated that we would likely explore creating a default energy bid in a future initiative. This is the initiative that we're hoping to do that in. So now we have 1,228 megawatts of batteries. So growing quick, and something that is, welcome in our markets. So we've had 9 stakeholders support further expansion and exploration in developing this default energy bid. The ISO's Department of Market Monitoring has placed a high priority on subjecting the growing number of hybrid resources to local MPM. And other stakeholders have advocated for allowing hybrids to bid up to the soft offer cap, which from the ISO's perspective requires some sort of cost verification. And that cost verification, for example, could be a default energy bid. So to add to that, stakeholders also see the storage DEB as linked to the hybrid DEB. So we had a couple stakeholders who supported using the storage DEB as a proxy for hybrid resources in the near term. We had other stakeholders who sort of said that a component-based approach would be key for a successful hybrid DEB. Now, most hybrid resources have a storage component, so with a component-based approach, it would require some sort of storage DEB in place to be the DEB for that storage component. And so with this context in mind, we've also had stakeholders advocate for postponing the development of a hybrid DEB until there's more clarity on where we end up as a community on storage DEB enhancements. And so with that in mind, the ISO seeks to improve the storage DEB as discussed earlier today, as also laid out in the December paper. And with enhanced storage DEBs, we look to leverage that for the hybrid DEB. And the goal here then is to postpone this topic until we are a little bit further along on the storage DEB as a whole. Okay. With that, any questions, comments at this time on this topic? Give it about 10 to 15 seconds. Okay, great. So then moving on to the next topic. So this is the topic that was formerly known as the co-located follow DOT topic. We are now calling it as the headroom limit for co-located variable energy resource topic. Note that this topic applies to resources that are variable energy resources that are co-located with resources that are providing ancillary services to the ISO. So what is the follow DOT? So the ISO issues dispatch instructions for real-time operations, and resources must fully and promptly comply with these dispatch instructions per our tariff. And inside these instructions, there is a target, right? The dispatch operating target, which is what has been determined as the optimal dispatch for that resource coming out of the nearest market run. So for variable energy resources, it's based on the most recent forecast that then goes into the market run, and then the energy award that comes out of it is what is that dispatch operating target. And importantly, for variable energy resources, the requirement is to follow or produce below the dispatch operating target, where for other resources, the request is really to follow. So a little bit more background on what does the dispatch operating target mean for co-located resources. So co-located resources share a point of interconnection to two resources or more that are modeled independently from each other. And the ISO issues the DOT to co-located variable energy resources to ensure a couple things. One is that total awards do not exceed the shared limit between the different resources. Another is to make sure that the ancillary service capacity that is awarded is deliverable. And current practice is for all ancillary service awards for co-located, for the associated resources to trigger follow dispatch operating target instruction to the variable energy resource. So last year in the policy roadmap, NextEra Energy Resources submitted a topic essentially asking to look more into this practice. So their view is that issuing the follow DOT flag in these scenarios discourages AS participation by these associated co-located resources. It therefore inhibits the price formation, the proper price formation in the market generally, and really poses a coordination issue when there are different owners or different operators between different co-located resources, right? Where if some sort of activity benefits one resource, but it has an impact on another resource that is under a different owner, the concern is that there are challenges there that could be that this practice could worsen. And an additional argument from NextEra Energy Resources was that there is an existing requirement for the ACC controller, which is it's the controller that prevents resources from going above the limit of the interconnection. There is an existing controller, right, that prevents that output on the resource side. And so the request was, hey, let's revisit whether this restrictive follow DOT flag remains necessary in all circumstances when co-located resources receive ancillary service awards. And so in response, the ISO believes that follow DOT flag does remain necessary to ensure that the ancillary service awards are deliverable, to ensure that there's no encroaching from other co-located resources on something that is that the ISO sees as necessary for reliability. However, the ISO also believes that there may be ability to allow variable energy resources to better use that remaining capacity, where maybe there's some sort of way where we can keep some sort of limit going forward, but also give a little bit more wiggle room as requested by stakeholders. And over the last few working group sessions, we've discussed ways to meet both ISO and stakeholder needs and have had highly productive conversations of the sort. And so, you know, with that, there's a new proposal in the straw proposal of introducing a new headroom limit value. And the goal here is to both meet the stakeholder requests and also the ISO goals around these processes. And what it sets up is two things that come, right? One is the existing dispatch instructions remain, right? Includes the follow DOT that ensures the deliverability of the ancillary service awards, and also kind of provides that instructed basis, right? Where this is what your dispatch is. There is also another element, which is this new headroom limit value. And the idea here is to tell resources, hey, this is your actual maximum possible real-time generation that we think that you can that is fine, right? But that's not what your instruction is, but it's something that you can go up to, right? The idea being fulfilling that request from NextEra Energy Resources to have a little bit more flexibility. And this headroom limit would be calculated as the following. So it's the aggregate capability constraint, right? It's that total interconnection availability minus what are the other needs that the associated co-located resources have. And this is energy awards and upward commodities. So things like regulation, things like flex ramp up, these sorts of things. And so this headroom limit, there are some specifications that the ISO sees as necessary for ensuring the reliability of ancillary service awards while also trying to provide that flexibility for stakeholders. One is that this is it's used in cases of ancillary service awards to associated co-located resources, right? So, for example, if a variable energy resource receives some sort of exceptional dispatch, right? That's not a situation where headroom would be provided. Whether that means that the headroom limit would still be calculated, but the headroom limit would be the same as the dispatch operating target, or whether there just would be no headroom limit provided at all. That's sort of an implementation detail that would be worked out later down the road. But the idea is that effectively, like if there's an exceptional dispatch, don't expect headroom because there's a reason why there's an exceptional dispatch in place. Another specification is when it comes to what if there are multiple VERs. So let's say there is 2 solars and a wind plus a battery in a co-located configuration. The headroom would be allocated pro rata by what the energy award sort of stated, right? And the logic here is that variable energy resources are impacted by the weather, right? And if there are resources that are being seen as able to produce, right, those resources also may have that ability to produce a little bit more, and therefore should be allocated that headroom accordingly. And the formula for how this would be conducted, pro rata is listed there on the screen. Next stipulation is that the headroom can't exceed resource Pmax. The idea here is that a resource that has a that hits a Pmax limit, the idea is that that resource can't, produce more energy than that, right? Where we're not expecting resources to go above their Pmax in any situation. And then the last thing is that this headroom that is used would be categorized as uninstructed imbalance energy, right? Where it's something that is, it's not, the instruction comes from the dispatch operating target, and any additional real-time operation flexibility is something that is it's an imbalance, right? It's not something that was kind of came out of that market run, the real-time market run. Okay, I see a question from Michael.
I think he lowered his hand. Oh, there we go. Michael, you'll be unmuted. Go ahead when you hear this mute
Just wanted
sound.
to confirm. So what this would mean, or maybe you confirm that the headroom number that shows up in ADS will never be less than the DOT, correct?
That is correct.
Okay, thank you. I actually think this is a great idea. So hopefully you guys can get some additional support and figure out a way to get this implemented.
Great. Really appreciate that feedback, Michael. And good question too. Okay.
And just a reminder, folks, to please state your affiliation. And Michael Carmack, I think he's from Boston Energy, if I'm not mistaken. Thank you.
Great. Thank you for that catch there, Brenda. Okay. So here's an example of what we've been talking about, right? So, let's say in a given market run, right, it comes out that the solar resource receives an energy award of 10 megawatts, the wind resource receives an energy award of 4 megawatts, and the battery receives an energy plus ancillary service award of 15 megawatts. And all three of these resources are behind the same they're all co-located behind the same point of interconnection, and therefore that the aggregate capability constraint that's tied to that point of interconnection is 36 megawatts, right? So with that in mind, right, because the battery has an ancillary service award, right, the energy awards for both the solar and the wind resource become dispatch operating targets, right? That's existing sort of process and policy. That's and that's just kind of what we're already doing, right? If you add up the solar, the wind, the battery, right, the blue bars, which is the energy awards and the dispatch operating targets and AS awards, you get to 29 megawatts. We see that this ACC has 36 megawatts of total room, right? So in the current structure, right, current processes say, okay, solar and wind, your DOTs are capping you, right? That's it, right? And the proposal here is to add this new headroom limit that would be communicated via ADS, where it says, okay, well, there's still 7 megawatts left in this ACC. Let's see if we can give that and sort of provide that information to that solar and wind resource in terms of what they can produce beyond their dispatch operating targets. And based off of that pro rata formula, the solar resource is currently generating. It has a predicted generation coming from the market that is higher than the wind, right? And in that sense, the solar gets a little bit more on its headroom than the wind resource does. And note that all of these, all of the Pmaxes for all of these resources are higher than any of the awards, any of the headroom limits. It's essentially these resources are not hitting their Pmaxes in this scenario. Okay, so what happens when the resources hit that Pmax, right? Same scenario, right? Where it's same in the sense that the aggregate capability constraint is 36 megawatts, right? The Pmaxes are the same, but in this one, the wind is not blowing at all, right? There is no forecasted wind generation at that 5-minute market run. And instead, we have a little bit more sun, right? So the solar resource is projected to have 15 megawatts coming out of the market run. And so, you know, the solar resource receives that dispatch operating target of 15 megawatts, right? And the battery is projected to have an energy and upward AS award of 14 megawatts. And then the 15 megawatts plus 14 megawatts is equal to that blue bar in the ACC, which is 29 megawatts of awarded capacity. Right? So with that, there's still 7 megawatts left over that otherwise isn't sort of getting communicated or used. And the proposal here is to say, well, okay, so we could give all 7 megawatts to the solar resource, but then the solar resource, you know, has a Pmax of 20 megawatts, right? So maybe instead of giving all 7 megawatts to the solar resource, to essentially giving more headroom than its Pmax, let's give those 2 megawatts to the wind resource that is not currently scheduled to produce anything, just in case, right? Just in case that wind resource suddenly gets a gust of wind and is able to generate accordingly. Okay, great. So, you know, the goal here is to seek some feedback on this concept, right? We've heard from Michael that it sounds like from Boston Energy's perspective, that at least from the initial get-go, that the headroom limit concept is a good idea and meeting that stakeholder need and meeting that request. We'd love to hear from others if that's the case, both here today and in written comments. And then are there other things that we should be thinking about, right? Are there any additional interactions? Are there any questions that people have, right? And, you know, this is something that if we're all feeling comfortable about, you know, it doesn't require a tariff change and sort of moving and implementing quickly after finalizing the design as quickly as possible. Question from John here.
Can you hear me?
Yep.
Okay. Yeah. So like being a EIM, EDM, and we're not really under the ancillary services, so I'm not specifically around the headroom, but my question is more around ACC. So we have scenarios where we are looking at getting hybrid co-located resources here in the very near future, and they're on a path that can be curtailed. You know, like say go from 400 megawatts to 200, like a reduction. And so my understanding right now, the ACC is set by the master file, which takes about a week to update. So have you guys thought about possibly looking at the ACC and making it more dynamic, where it could either be controlled through like an outage card or through telemetry from the BA? So when we have a curtailment or something, that we can accurately reflect that in the ACC limit?
Great question. I think this is something that may have some consideration elsewhere in the ISO, but it's not something that is something that we've been discussing here in storage design and modeling initiative. So I think this is something that if you could shoot us an email offline with this sort of request, we can take it and take a look at it. It sounds like it's something in scope, but it's sort of, in my mind, a different topic than what we have here today and also what we presented in the paper. How does that sound?
Understood. Thank you.
Okay, great. Thanks, John. And I was trying to be, you know, helpful with sort of, you know, I'll try to be helpful with sort of demarcating that WIM versus sort of BAA topics as you've requested in the past. And you know, I think this here is one that is mostly BA, but you know, if there may be resources that are in a co-located configuration that are providing ancillary services to the ISO, you know, that's where there are kind of cases where that could happen. So that's why I didn't want to start this off as a BAA topic only. Okay. You've got a question from Sean.
Yeah, Sean, City of Vernon. We have a co-located unit that we continuously having issues with our ACC limit when the aggregate of the solar output plus the awarded ancillary services exceed the ACC. And what we're seeing is the solar getting curtailed to honor the AS award. So our solar or our ACC cap is our PMAX for our solar. So for example, 50 megawatt is our cap for the solar, is our PMAX, and which is the same as our ACC. Anytime we get close to that number, and if there's an award in the real-time market for the AS, our solar continues to get curtailed, causing an issue that we need to keep ourselves out of the market during the middle of the day. Will this headroom concept take care of this issue, you think?
So I think the answer is yes, but I want to make sure I understand more about the case here, right? So you said that this is City of Vernon, right?
Yes, that's correct.
And this is a co-located resource where the solar has, like, where the ACC is equal to the solar PMAX, but there's also another, but it also sounds like there's another resource behind that co-located, right? Because it wouldn't just be one.
Sure, yeah, solar and battery, yeah, so.
Solar and battery.
Solar and battery, WDSC, and yes, so I give you, and then anytime the solar is at its PMAX or just about at its PMAX, for example, so if you use a 50 megawatts PMAX, if there's that's 48 and we get awarded AS in a real-time market of 7-8 megawatts, the solar gets cut. This is middle of the day, so the battery's not doing anything. It's just either it's charging or it's just sitting idle. So that to award that AS or it cuts or curtails our solar output. So
okay, and that award is going, that 7 or 8 megawatt AS award is going to the battery. Is that correct?
That is correct. That is correct.
So the concern here is that 7 or 8 megawatts is then eating into the solar, where the solar would otherwise be able to generate up to 48, let's say, but then it's receiving a dispatch operating target of 42 to ensure that room for the battery. Is that correct?
100%. Yes, exactly.
Okay. So in this scenario, you know, I think if the battery ancillary service award was smaller, right, that would be something that, you know, because like with like whatever that ancillary service award is,
right,
it's something that the ISO sees as needing protection, right? This is both current process and this is also under a headroom limit scenario, right? Where you know, if there's an 8 megawatt battery award, right, then the max that solar resource could go up to is 42 megawatts. In order to make sure that there's it's essentially reserving that 8 megawatts for that battery AS award, right? So, you know, this would not be something that would be headroom limit eligible because of the fact that the reservation is there, right? It's blocked off, right? Now, if the battery was receiving a 2 megawatt sort of ancillary service award, right, and upward ancillary service award, and the solar forecast was for 45 megawatts, right, then that is a situation where the headroom limit would kind of bump up, right? That sort of on the solar resource side, because, you know, the ISO sees it as, okay, 2 megawatts for the ancillary services already sort of secured, right? That's something that is capped, and then, you know, the the additional flexibility that that solar resource, you know, there could be extra energy coming from the solar resource. So that scenario, which might also be happening to your resource, I don't know, and I'm sure you know much more than I do about that. That is a scenario that would be covered under this headroom limit. Does that make sense? Does that help?
It does. It is just awards. It is no energy behind it. It's just reserving those rights or reserving those megawatts for that particular hour that cuts into the solar. So that said, we got to try to keep the ancillary services to a limit when it comes during peak day or peak of the day, because we could just keep getting curtailed. So yeah, so this headroom would not take care of this issue that what you're talking about is for.
Okay, can I briefly chime in here, Dinesh?
Yeah, go for it.
I think if we go to slide, to the slide where we have the formula, it would be helpful. Yes, so there are kind of two innovations here, I would say, Sean. The first one is that we are now conveying a new data point to the assets, and that we're going to call the headroom, right? The headroom limit. The second innovation is that the headroom limit is informed by the ACC minus the upward commodities and energy awards. So today, what is happening to co-located resources out there is that both upward and downward commodities are informing the DOT that the solar gets. So let's say that the storage asset in your configuration got, reg down, and which is a downward commodity, and then all the other ones as well. So now all of those are informing the DOT. The innovation of the headroom limit is that only the upward ones will inform that headroom limit. So in your scenario, it will address the issues it will address the reservation associated with downward commodities.
Okay.
And that's how it will be a difference in the headroom limit, no? But the upward commodities still inform the headroom limit. So if you have reg up, spinning reserve, non-spin, flex, ramp up, like those will be respected by the headroom limit. Dinesh, anything to add there or correction there? I think that's
that's accurate. Yeah, I think Sean. So I don't know if any responses to either of our clarifications there.
No. Well, I'm pretty sure that as far as the reg up goes, we have no. That's where we have the issues. Where we have reg up awards, and the solar is already close to its max, and the difference, the delta between the two is curtailing our solar. I think on the reg down we have no issues because in the middle of the day, bringing the unit battery down, it gives us actually more headroom or more room between our by our ACC. The issue is the reg up award.
I think too, from our perspective, that's not necessarily an issue, perhaps, right? From our perspective, like we want to be able to accomplish both of those goals of giving a bit more flexibility via the headroom while also ensuring AS deliverability. But yeah, my apologies, Nish, go ahead. Sorry.
Yeah, so let me ask you this, Sean. Is the request here that the battery doesn't receive an upward AS award? Or like what is the ideal situation or resolution in your mind on this situation?
Ideally, if it's just an award, it should not be curtailing our solar output. Okay, if you need energy behind it, that we can understand. But if it's just a AS award, I know you're reserving that for, if they need it. But as far as we're concerned, you have to stay out of the market during those mid hours, so our solar doesn't get curtailed. That's what we're seeing. So we're trying to make sure that the solar doesn't get curtailed, but these awards are limiting us when we get this upward or reg up awards.
Okay, so then in that sense, it's almost like the preference is that you'd rather receive, and I'm just trying to understand here, that you'd rather receive no ancillary service awards and sort of allow your solar to kind of produce as much as possible instead?
Correct. Exactly. Well, that's what we have to do because we don't want to keep getting curtailed.
Yeah.
So that's what we're forced to do.
Yeah. Okay. And I think, okay, so it sounds like that is one option. I think unfortunately, like, you know, this is something where the ISO feels pretty strongly that there should be, if there's a regulation award, regulation up award, for example, just putting that out there, right? Since this is what we're talking about. If there's a regulation up award, you know, the ISO feels pretty strongly that there should be enough room in the deliverability to ensure that that regulation award is deliverable, right? Where we just do not want any sort of issues with that, and it's like in the awarding of that AS award, it's we need to reserve this amount of capacity to ensure the deliverability, right? So I think with this situation, I don't think, like, if the AS award is awarded, right, that regulation up award is awarded, then the ISO sees it as very important that it's deliverable at all times because at any moment we may need it, right?
No, I understood.
Yeah, go for it.
I understand. That's exactly why we have to limit it because no, we see that you have to limit it to the ACC limit, and we do have to back that down because if you don't want to get curtailed, so it's one or the other. But I was just hoping this would actually resolve the issue, but apparently not on the reg up. But thank you though, appreciate it.
Yeah, glad to have this conversation. You know, and I think, and I'm hoping that this will help other stakeholders on the call sort of understand what is something that is applicable here, and what is something that the ISO sees as, you know, this is a request that we can't meet, if that makes sense. Okay, we got a lot of questions on this. So thank you, Sean. Brenda, could you pass this to the next one?
Yes, so we do have a lot of questions, so we'll be monitoring questions as well. If you'd like to submit them through chat, we could also answer them quicker. First one, we have Mike McGruffin. Please introduce yourself after 2 seconds. Thank you.
This is Mike McGuffin, CES. With regard to regulation down, is the ISO now proposing to eliminate the automatic follow dot assignment in the event that there is a regulation down on the co-located battery?
That's a great question. So what it would be is the proposal here would have it such that the regulation down award is put into place, right? So let's assume that the energy award in this example is 15 megawatts, and the regulation down award is 5 megawatts, right? So the regulation down award doesn't actually filter into this headroom limit calculation, right? Because it is not an upward commodity, right? So what would happen is the ISO would give out a dispatch operating target of the 10 megawatts, right? That is kind of seen as the award coming in, right? But then the headroom limit would also be given, right? Where that headroom limit, for whatever the remaining capacity is, that's kind of how it comes in. So that regulation down award impacts it where the ISO would still like to give out a dispatch operating target, and based off of based off of ensuring that certainty, the dispatch operating target would still be the energy award. So I guess the follow-up to that question is, well, what would happen if that dispatch operating target was higher than the energy award? Then if a resource was to produce under the dispatch operating target, right, let's say at its energy award, then it would be uninstructed imbalance energy in the downward direction, right? So from a settlement standpoint, that's where, you know, the proposal has kind of put it has maintained that the dispatch operating target is equal to that energy award coming out of the real-time market run. Did that answer your question?
No, I think I'm still confused. So I understand the regulation energy settlement for the BESS would be complicated with UIE, but for the solar, the reg down's not impacting any upward headroom. You know, it doesn't matter how much reg down is sold on the BESS relative to how much room there is on the upside. The ISO still issues that follow dot instruction. So I guess and this is the main issue that we raised with the Cal ISO back in 2021. So I'm just trying to figure out if this proposal somehow addresses that or if it's status quo.
Okay, so maybe I didn't understand fully what your question was again. So let's try. Do you mind restating your question just so we can get into it a little bit more?
Sure. So anytime there's reg down sold on a co-located battery, regardless of the quantity, the co-located solar is issued a follow dot flag. So it's held to its forecast. Yep. And there's no consideration of upward capability or headroom. It's just if you sell a megawatt of reg down, you immediately get a follow dot flag for the solar.
Mm-hmm. Okay, so that would be a scenario that would, so in current practice, you get that follow dot, that's it, right? You gotta either produce that or under, right? Under this proposal, in that scenario, you'd get that you'd still get the follow dot, right? That's something that is, you know, it's seen as helping protect that AS award. So that's why it's got to go in. There's got to be some sort of limit somewhere. But what you'd also get is you'd get the addition of this headroom limit, right?
But the headroom doesn't.
That dispatch operating target.
Yeah, unless the headroom is actually to the extent the ISO is under forecasting a unit and it's held to its dot, the upward headroom doesn't have any benefit for the resource. And I think that's where, you know, it's a significant issue because, you know, we're selling reg down during solar hours. The batteries are persistently under forecast. And so there's a lot of foregone solar production associated with hours where reg down is sold on the battery. And I would just hope that the ISO would come up with something in the proposal to accommodate that issue, because I think that's probably a bigger issue than the upside issue that you guys are addressing with the headroom proposal.
So the hope here is that we are actually, you know, I guess the hope here is that headroom limit would actually help out with this issue, and I guess what I'm hearing is that this isn't a solution that sounds like it is helping from you and your perspective. So I guess what would be an example? Do you have anything in mind that you'd say, hey, this is what would help out the scenario?
Yeah.
Can I also add something here very quickly? Just very quickly. I think part of what you're asking too, Mike, is what's the interaction between what the asset can do given this DOT and headroom limit being different? No? Like what do they gain by getting both a DOT and a headroom limit that then is higher? And what we're putting forth in the proposal is, you know, in this situation, the asset, the solar or wind resource, the VER, gets a DOT that is unchanged, but they also get the headroom limit. If the headroom limit is greater, then these resources can limit their generation to that headroom limit, not to the DOT, if the headroom limit is greater. So the DOT will be issued, it will include all of those commodities as it does today. If you had any downward commodity on the storage, then your headroom limit will be greater than the DOT, no? Because there's a difference there.
Yeah,
Now,
but Sergio,
if that headroom limit is greater, these resources can now limit their generation up to that value. And that makes it so that they can take advantage, greater advantage of that interconnection. And we still, have the ability to convey both of those kind of levels of where you can be in the most kind of conservative way, but where you could go given the nature of the awards. Hopefully that also gets a little bit to your question. Yeah.
And now, so the fundamental problem is that the dot instruction that is generated for a solar resource is directly it's generated by the 5 minute the final 5 minute VER forecast for that interval. So there's no ability. So the ISO actually replaces the upper economic limit for a resource in the 5 minute market to that forecast value. So there's no ability to operate or bid above that because that's just the way that the VER forecast process works. And so we may have headroom, but there's no mechanism for the unless you allow the solar to generate as capable and exceed that dot. There's no way for the solar to take advantage of that headroom.
Well, I would argue that the goal here is that it does allow the solar resource to take advantage of the headroom, because what we're saying is that in these limited circumstances, the solar resource can exceed its DOT.
But if you issue a follow dot flag, it can't. And that's where all of these systems are automated to either follow the dot or gen is capable. And so if there is an ADS follow dot instruction, the units will be held to that dot. If you're saying that there's some mechanism that we can, if there's headroom, the follow dot flag would, or maybe we get a new follow dot flag, something different than the current mechanism. But right now, that scenario doesn't work. If we're a 50 megawatt resource, solar resource, and our forecast is 40, but in reality we could have generated 45 because the ISO under forecast the resource, we would get a follow dot instruction given, assuming the reg down on the battery, we would get a reg down instruction, or sorry, a follow dot flag at 40. And there'd be no way for the battery or for the solar to increase the production to its capability.
Got it. So the proposal here would be to say, yes, the headroom limit is something that comes with the dispatch instructions, right? It is a thing that it's a new concept that would be added. So you're getting the same follow dot flag, but the idea is that follow dot flag also in the same instruction is getting a headroom limit parameter, right? Now, I guess my question for you is this something that is a change that is from the ISO system perspective, or is it a change from the resource system perspective to be able to integrate that headroom into what is getting to avoid that curtailment of that solar resource?
It would have to be a change on the ISO side. So the definition of the follow dot, there would have to be a different dot flag that reflected additional headroom, because right now it's just binary. You're either following your dot or you're not, and your generating is capable. And I would argue that we've had this discussion for years now, but I just can't see how a co-located resource selling regulation down impacts the co-located solar. If there's a solar resource across the street, it doesn't, and it's not co-located, it doesn't impact it. But the regulation down doesn't impact the upward, it will not impact the upward ACC limit, the POI limit, whatever you want to call it, because it's always going to be in the down direction. So that's where just fundamentally, I disagree with the idea of the follow dot instruction for reg down on co-located resources.
Got it. So I think there's two parts of this. One, Mike, that's super helpful to know that it's on the ISO system side, because that means that that's something that we are able to make sure that we can address that in our implementation of this proposal, right? Where the goal here is to be able to use the headroom limit, right? We don't want to just send a headroom limit that doesn't get used, right? That doesn't, then it's not really helping anyone, right? We're spending time making the change in the systems, but then it's like something that, because something else, we can't use it, right? So, the goal would be to ensure that that headroom limit can get used. And if it's on the ISO system side, we can make sure that we go back and double check that this is something that is done. From my knowledge, we have done that check, and it's in the proposal to change it such that the headroom limit can be used, right? That's part one. Part two, I think on the regulation down piece, sort of your disagreement about whether the regulation down would impact, or if there's any scenario where the regulation down sort of could be, where that regulation down award could be infringed by kind of generation as capable from a variable energy resource. That is something that the ISO, the ISO believes that there are situations that a regulation down award could be impacted by an as generable caping variable energy resource. An example of this might be like something that is very, very like super tight to the ACC, right? You got a regulation down award on a BESS that's 5-10 megawatts, right? And you've got an as capable generation coming from a variable energy resource, right? If that BESS comes down, right, 5-10 megawatts, and that solar resource is still generating as capable, and that solar resource is kind of blast through, the concern is that BESS can't come back up, and therefore can't actually fulfill its regulation down award during that interval. So I think this is something we talked about back in sort of the November presentation. I think this stuff is really complicated while we're sort of discussing this, and but that's something that the ISO believes that there are situations where regulation down awards could be impacted by an as capable producing BESS.
Okay, I would argue otherwise. I'll let others talk, but I think the solar is being just dealt with in the market mechanism, and AGC is dealing with the movement of the battery. And so I think control systems on these facilities would prioritize the AGC signal and move the battery accordingly. But I'll let others speak, and we'll submit comments. Thank you.
Thank you, Mike.
Next, we have Sam Hill, and then John D, and then Raul will be the last one for this queue.
Thanks, Derek. Can
Go
you hear
ahead,
me?
Sam. Yes, we can.
Great. First wanted to say thank you to the ISO for your continued attention on this, since we're the ones that, raised this issue pushing a year ago. It's great to see we still have had, all this great continued discussion. I also thought the discussion paper, the issue paper, did a really good job of making this technical issue accessible to everyone. Overall, we were pleased to see this updated proposal. It seems like it tracks the previous versions of the proposal, previous ones pretty closely, and would meet, the objectives that we, led us to put this issue out in the first place last year. In particular, I think the gentleman from who spoke before, Mike, I kind of heard that comment as really what motivated us to propose this, which is that, we have been historically kind of leery about bidding ancillary services on our co-located batteries during solar hours because we don't want to trip this follow DOT flag for the solar unnecessarily. So it's great to see there's some movement here. I did have a few clarifying questions, kind of some of which along the lines of what Mike was just raising. The first one, I think we had a similar take initially, just looking at the plain language of the formula. That was maybe a slide or two ago. It seemed pretty self-evident, I guess, that only upward ancillary services would impact the headroom limit calculation. And I kind of just I guess, assumed that implicit in that there wasn't going to be any more follow DOT flag. Like this is how the ISO proposes going forward to ensure AS deliverability and a dispatch basis for settlements. Those bullets up, at the top. I kind of thought there wasn't going to be any more follow DOT flag, and it would just be if that co-located battery is carrying reg up or spin or non-spin flex up, then headroom limit calc goes out, tells the VER or VERs how much they can generate. So we definitely started from that same default position that if that battery is carrying a reg down award, that would have no impact under the plain terms of this formula itself. And we're going to ask if the ISO could just put that in writing as when they get to the actual BPM language. But now I'm hearing, well, maybe actually that follow DOT flag would be retained in this instance of the battery clearing reg down, which, yeah, we did not expect it to still be necessary because we didn't think it would impact the amount of upward headroom at the POI.
That's a great, first off, thank you very much for that feedback, Sam. I'm glad that it was something that you found accessible and sort of that the write-up is working. To sort of talk about your question on the reg down and sort of the need for continued follow DOT instructions, that is something that, we did think about that in discussing with the team. And it's something that we came back as, there's a strong stance that we need to keep a follow dispatch operating target in place. That there needs to be at, all times, if there's an ancillary service award that's going out, right, that ancillary service award needs to be deliverable. And in order to make sure that ancillary service award is deliverable, there needs to be a dispatch operating target that holds, that prevents resources from sort of, generating as capable, if that makes sense. And so, with the idea with the headroom limit is that, yeah, there's a little bit more room, right? But at the end of the day, it's like, it's a do not exceed the headroom limit. And then it's also, it's something that, from a settlements perspective, we also want to kind of keep the DOT at the sort of, that's the instruction, right, of where the resource should be producing. And any additional is, something that comes in, that's uninstructed, right? So, if this is something, I'm hoping this answers your question here. Otherwise, feel free to sort of kind of let's iterate a little bit here, but we can also take it as written comments too.
Thanks. Yeah, I mean, I guess what I was trying to say is that the proposal in general to retain the dispatch operating target and supplement it with a new point that gives the VER, its headroom limit, having two pieces instead of one, that makes perfect sense and seems like a logical way to ensure AS deliverability. But I guess now, based on this discussion, I'm still a little confused as to whether, because it sounds like there's maybe different treatment. If the battery carries a reg up award, it sounds like the VER would still get its DOT, but it would have a headroom limit to go up to that certain amount if it's available, which sounds great. But then if the battery gets a reg down award, it sounds like not only would the VER continue to get a DOT, but unlike the reg up case, it would not get a DOT plus a headroom limit. It would just get a strict DOT because the existing follow DOT language would be retained and applied to it. So unless I'm hearing it wrong, it kind of sounds like we have different treatment now under this proposal for upward ancillary services and downward, whereas I thought it was just going to be new treatment for upward AS with this new headroom calc, and under that formula, there would be no follow DOT flagged to require strict, following it in the downward AS case. But maybe that's inaccurate.
Great question. So the proposal is a little bit different than what was stated back there. The proposal is in kind of cases of downward AS that we, that we do still issue a follow DOT and we issue a headroom limit. So both get issued in the case of a regulation down award too.
Okay, so you're still issuing the follow DOT, but it's not like you actually have to follow it strictly because you would be allowed to exceed it up to the amount of headroom. So maybe it's like a semantics thing. You get the DOT, but you don't have to you would be allowed to exceed it, unlike status quo, right?
It's, you know, semantics is one way of sort of discussing. I think another thing is there are settlement implications that come off from having a DOT that is different than a headroom limit. Sergio, please add.
Yes, I think a lot of the conversation we've had in the last couple of questions is all related to what we stated at the beginning of 4.2 in the paper, page 10. So really the goal is, in any situation, the VER is going to get, in any situation where there is an AS award to the non-VER collocated resource, the VER will get both a DOT and a headroom limit. There will be instances where the DOT and the headroom limit are the same value. Which are those instances? When all of the AS award on the storage in this scenario is upward. In that situation, you're going to get the same value in the DOT and in the headroom. No? There will be differences when there are also in other situations, like for example, when you have some downward awards. Now, these resources now, even if they got the DOT flag, the follow DOT flag, they can generate up to that headroom limit when it is different. If it is greater than the DOT, they can generate up to that limit. And any energy that they generate up to that limit different from the DOT is uninstructed imbalance energy and is subject to the same settlement charges. So what we're trying to convey really is this headroom limit will allow resources to be able to take advantage of more of the interconnection in some circumstances, and they'll be able to know up to what level because they will be communicated simultaneously. But there will be instances where the value is the same, no? But in others, the value is greater in the headroom limits. So hopefully that helps a bit. A closer read of page 10, I think, addresses some of these questions too, but please feel free to ask if we can provide more clarity or restate as well. Thank you.
That does. Thank you, Sergio.
Okay, and I tried to answer a couple comments that we received in the chat very quickly. Thank you very much, everyone, for your feedback. I think this conversation is going very well. I think this is complicated, and my understanding is that we've been succinct in avoiding restating points so far.
All right, so we do have one more. I think Raul, and another Raul has a question, but John Deep from SCE, if you can be brief, that'd be great. Thank you.
Can you guys hear me?
Now we can.
Okay, great. Yeah, thank you. This is John Dieppe from SCE. Just wanted to send our appreciation for the continued development in this area. Really appreciate it. We think it's a really positive step towards the entire follow DOT flag and such. One question I do want to ask is that I see on this page 53, you're calculating the upwards commodity and you're considering spinning and non-spinning reserves as part of the calculation. I'm just wondering, has CAISO thought about maybe not including that unless a contingency event is triggered? And that would actually provide more flexibility for the VERS to even go higher for those that are have spinning and non-spinning reserves.
Great question, John. CAISO has considered that. And, our stance here is that all ancillary service awards, we want to make sure we maintain the, deliverability and sort of like really kind of locking it down, right? Because, if we're waiting till a contingency event, right, It's something where you know, it's like you don't know if you need an ancillary service until you need it. And then like some of these, like in terms of those contingency events, and then in those cases, it's like, well, you need it now, and the operators need to be able to act on it immediately, right? So the goal here is to really give them that protection and sort of like clarity of mind to say, if you call on this spinning reserve or non-spinning reserve, you are going to get it. It is deliverable. Right? We know it's a deliverable. It's something that is, you know, baked into the proposal that, you know, that is protected, right? So, you know, I can run that back to the team, but that's kind of the type of conversation we've been having so far, if that's helpful.
Yeah, that is. Thank you.
And I think we do have one more. I'm confirming with Raul. Please unmute Raul.
Hi, this is Rahul with AES. Can you hear me?
Yes.
So I had similar question as Mike and Sam, and I think it got answered that CAISO's position is that when you have regulation down, there will still be follow DOT. But the subsequent discussion, I'm a bit confused. And let me restate the question. What I heard from Sergio and Dinesh, that in case when you have regulation down award, and if you have headroom, you don't have to follow your DOT as long as you don't exceed your POI. And please tell me if I'm not restating your position, but that's what I'm interpreting. Is that correct?
Sorry, Rahul, can you state it one more time? I had a little bit of a headphone issue there.
So the question is, you said that if you have headroom at your POI based on your dispatch, then the solar can dispatch as capable as long as it doesn't exceed its POI. And it'll be a settlement issue of what is considered as instructed versus uninstructed. Am I hearing it right?
If I may, I'd say,
okay.
It's not that they can generate as capable, is that they can generate up to the headroom limit, right? Like that's the key thing of the headroom limit. The headroom limit, in many circumstances, as laid out, in the paper and in the prior conversation, will be greater than the follow DOT. And now resources can generate up to that value of the headroom limit. If they choose to, any energy will be uninstructed imbalanced energy and would be settled the same way. So that's kind of what we're doing. We're now giving you a new data point as to at what level you may be able to generate at. In many circumstances, the DOT value and the headroom value might be the same, but in others, it'll be greater. The key difference there is, as you can see in the slide here, how the VER headroom limit is defined. That is really looking at ACC minus upward commodities plus energy of the other collocated resource. The follow DOT flag, we're not changing how it's defined. Therefore, you will get instances where the headroom limit is greater. Now they can generate to that limit, not as capable. Okay?
So the question is, the follow your DOT from my experience was like a NERC directive of following your dispatch. Is that no longer the case? That the follow DOT instruction is no longer an instruction that you have to follow exactly what you got in DOT. You could go up to your headroom. And I'm trying to figure out how would that work in terms of ADS and dispatch, right? Like how would the operator know what are those two numbers?
Yeah.
So previously, go ahead, Dinesh. Go ahead.
Okay. Yeah. No. We've got phone lines. We've got chats. I think this is really great, and hopefully we're getting there on the explanation. So, So that the follow DOT is going to come packaged with the headroom limit, right? In these specific circumstances, right? So, you know, the idea is it comes through ADS at the same time. And from a KAISO implementation perspective, the idea is to have like it's essentially Gen is capable up to the headroom limit, not the follow DOT.
So instead of getting a DOT, so does my DOT now include the headroom?
From a settlements perspective, yeah.
Yeah, I think this is difficult in the discussion, so it is easier if you can provide like as much details as possible in writing. And you know, I can follow up offline, but I think any details of how it would work in ADS with examples would really help understand, you know, what that implementation looks like.
Yeah, that's really helpful feedback, Rahul. And you know, just to give a quick response here from the proposal implementation aspect, it's, you know, you're currently getting just the follow DOT, right? The idea
you get
is
follow DOT and your DOT, right? Like you do get a DOT instruction, and I know I cannot exceed that instruction.
Yes. So the idea would be that, you know, this is all in ADS, right? This is all, you know, automatic in a way, right? Yeah. And the idea would be that ADS instruction now has both follow DOT, but also a headroom limit, where the headroom limit is higher than the follow DOT, and actually resources are allowed to produce up to the headroom limit, right? The DOT is there as this is where we are expecting the resource to be, and from a settlements perspective, this is where we're expecting the resource to end up. And then using that headroom is, you know, uninstructed imbalance, right? Rather than instructed imbalance.
So that's the big difference with this implementation.
Sorry, could you say that one more time?
So that's the difference where if I was generating as capable, everything would be instructed. With this,
yeah,
I still have ability to generate, but I have instructed and uninstructed.
Well, I don't know if generating as capable is it. I'm not sure if that's instructed or not. Whether it's if you're generating past your energy award, that's something that I can review with the team and get back to you on an answer on. But the idea here is that, yeah, that DOT is, you know, is linked up with the headroom limit, and the headroom limit is actually that cap, right, rather than the DOT.
Yeah, that explains it. Yeah, but my feedback, and we'll put it in writing. You know, as many details as you can include would help.
Okay, great.
I'm glad
that was helpful. Yeah. Okay, I tried to get everything in the chat too. Yeah, I'm not seeing anything on the phone lines either.
Yeah, that's correct. Yeah, we're good to go.
Okay, great. Thank you, Brenda. So then let's. Oh, I see one more hand up from Mike.
All right, Mike, if you can be brief, I did see your chat as well in case. Go ahead. You'll be unmuted.
Hey, sorry for the last minute question. I just wanted to ensure I'm understanding the proposal. So we went through the upward headroom calculation. Is there a reciprocal, like any possibility of headroom being calculated in the event of a reg down award?
Great question. Under the proposal, whenever there is a reg down award, there will always be a headroom calculation, unless there is like some other circumstance, right? Like where it's like you know, like an exceptional dispatch or something, right? But like the idea is that yes, there is a headroom associated with a regulation down award, unless there's a extenuating circumstance.
Okay, well that's helpful. I think that clarifies it for me. And then when the implementation comes, as Rahul was describing, there would be an ADS dot. There would be another point that will now incorporate into the control systems that say follow dot, but you can follow it up to you can exceed that dot by X megawatts.
Yeah.
Perfect. Okay, thank you.
Great. Thanks, Mike. Okay. With that, let's move on to the next topic. I know we're running a little short on time, so we might need to save some discussion for written, but we'll try to get through as much as we can as possible. So next part of the paper is on high sustainable limit guidance. So, you know, just a summary, we've been talking about this for a couple months, but just a brief summary here. What is the high sustainable limit? The idea here is that it's a calculated value for what are you capable as a VER besides weather. So this is useful. This is very useful forecasting because, you know, it's not impacted by an ISO dispatch in like a follow DOT, right? Or some sort of transmission constraint, right? And, you know, you wouldn't want that in your forecast, right? You want the forecast to only be dictated by what's going on with the weather and what's going on with the resource, rather than what's going on with the ISO conditions around the resource, right? So, you know, we've included the following chart in the paper as well. The idea is that whenever the sun is shining, that, you know, contributes to the high sustainable limit, and however much the sun is shining, right? So in scenario 3 and scenario 4, right, partial sun probably means that a solar resource has, you know, a lower high sustainable limit, right? But ISO generation limit does not mean that the solar resource could produce less, right? So that's scenario 2, right? And scenario 4. And all of this is separate from the power maximum, the PMAX, which is something that's kind of baked in ahead of time, right? So the high sustainable limit is something that's happening instantaneously or almost instantaneously, whereas the PMAX is kind of the overall resource criteria. So ISO encourages all variable energy resources to submit HSL data, right? You know, the ISO forecasting team sees it as good HSL data is very helpful for forecasting purposes. And you know, really getting that accurate forecast out to all. And with that, though, there are some VERs that are required to provide forecasting, and that includes those providing AS. That includes hybrid resources with VER components, and that includes CAISO BAA co-located VERs. And this requirement is every 12 seconds. That is. So here are some examples of where the ISO has received poor quality HSL data, and this is what the ISO is really concerned about in this topic, where, you know, poor HSL data is something that, you know, we've been monitoring, and we're just seeing that there are things that it just doesn't strike us as something that could happen with the HSL, right? Given what we're seeing in other aspects. So in example 1, right, the resource has, you know, no instructions to hold generation, you know, below, like there's no DOT, there's no like exceptional dispatch saying, hey, can you hold it below what you're capable of? And the HSL data is not showing that, right? The HSL data is showing something higher than what the telemetry is, right? And that's an example where the ISO forecasting team looks at it and says, hey, maybe there's something a little up here. Another example is that ISO dispatch, we're seeing situations where HSL is impacted by ISO dispatch, where, you know, as you can see in the top half of this second example chart, the HSL data is bouncing around, right? In the same way that the telemetry is bouncing around, but the sort of a proxy measuring for what solar resource could produce via its irradiance is not bouncing around. It is pretty, you know, it follows what looks like a otherwise normal curve. And that's another example where it seems like the HSL data that's being provided is poor quality. So what are the impacts, right? So HSL is currently used for calculating real-time forecasts, right? And it weakens that relationship between because it's one of the inputs, it weakens the forecast and like the relationship between forecast input and the generation. And that leads to, you know, more inefficient dispatch, right? Where the forecast may come below or above what the resource is actually capable of doing because data point that is a little weak, aka the HSL. But one other problem is that it's not like the ISO can go ahead and sort of fix all of it at the same time, because different resources have different quality, aka some are providing poorer quality HSL than others, and there's a bunch that are actually providing great HSL data, right? So we can't systematically account for these errors. And if with good quality HSL data, it also it opens up the ISO to use more tools and methods that will give stronger forecasting, and sort of more. And the idea is to get the most accurate forecasting we can get. So what is the proposal for where this is going in the BPM language, right? So it's clarify what like right now the BPM language and the tariff language surrounding HSL do not have there's not really a clear definition of what is a good high sustainable limit. And the idea would be to add some of those things in, right? Where we say, look, and if there's no impact from an ISO instruction, then the HSL should be equal to the generation, right? Because if you're producing as capable, well, your HSL should be reflective of what's capable, right? So therefore, your HSL should be equal to your generation. When the ISO is when there are instructions, right, then in those cases, the HSL should be higher than the generation, right? Because the ISO instructions should be, it's something that's limiting your as capable generation, not something that is, pushing you. There's no way that the resource could produce past it's what's considered as capable, right? So there should be no situation where the HSL is lower than the actual generation. And a third thing is to say, for hybrid resources, the HSL data is based off of what is the weather, right? So something like battery charging is not something that is the weather, right? And therefore, should not impact the HSL data. Second part of this is to, provide example guidance methodology on what are some methods for providing HSL in a way that works, right? There are many different resources that have many different factors that could feed into how the weather impacts generation, and it's something that we rely on resources to come up with that calculation and guidance based off of the data and the information that resources have. So if in this example, it is one example. It is not there are other calculations that would meet the requirements, and at the end of the day, the idea is to meet the requirements, right? So in this kind of proposed general example guidance methodology, right? It would focus on solar resources providing on high sustainable limits, and the idea is to link up generation with solar irradiance, which is the power density coming from the sun, and using that irradiance as a proxy when there's an instruction impacting generation. So on the previous slides, right, was stated that there are situations, if the ISO provides a dispatch instruction, right, it will impact, it will separate the HSL. It could separate the HSL from the generation, right? And in those situations, let's come up with a way to bridge between other situations where we know the generation equals the HSL. And the idea is, get a proxy, right? Build a historical relationship between the proxy and what actually happens in the generation, right? And figure out what that relationship is. So this chart might be helpful where the idea is you look a month before and you say, okay, well, if the irradiance goes up by this amount, we've seen in the past that this amount of irradiance leads to this amount of increased generation. Right? That, use that to help with the HSL data, right? Where, okay, so in this interval where the ISO is impacting, where ISO dispatch is impacting the generation, there's you've got the interval right before that is generating as capable, and then you've got the interval after, right? But in the middle, use this irradiance guidance to say, okay, well, if in these intervals the irradiance goes down or goes up, well, that has a demonstrated relationship with how much the potential generation could change, right? And at some point, there's a saturation point, right, where increased irradiance doesn't actually lead to more generation, right? And that's going to vary by resource, right? But the idea is to provide that saturation point. And then at that point, if there's an increase in irradiance, but you're already at the generation point where an increase in irradiance doesn't matter, then it won't matter, right? And the HSL should not reflect that increase in irradiance. Okay, great. Any questions on this topic at this time?
I don't see any questions in the queue, Dinesh. Thank you.
Okay, great. Thank you, Brenda. All right, we'll move on to the last topic of the day. And so this is on mixed fuel and storage services, specifically focused on the interplay between hybrid resource and AS and dynamic limits. Hybrid resources have dynamic limits, which they use to reflect changes in the real-time operating capabilities, like if there's charging of a storage battery, right? And simultaneously, all resources, including hybrids, providing regulation are required to deliver the awards for the hourly award, right, consecutively. And with hybrids in particular, with these dynamic limits, the goal is to allow hybrids to self-optimize, and therefore hybrids are fully responsible for meeting these requirements and continue to be required to do so. Right? The ISO sees any, written in the tariff, right? The submission of bids for market services also serves as an attestation for expected availability. And what we're seeing is that, certain kind of usage of dynamic limits, it hinders the ability of resources to meet their AS requirements as stated in bids and as stated in the tariff for making sure that you need to meet the AS requirements. And this, to the ISO, produces a reliability risk, right? As we talked about in the co-located headroom conversation, right? So the ISO wants to see AS awards that are they must be deliverable. They must, the idea is to be able to meet them at any moment that the ISO needs to call on them, right? And if the dynamic limits are infringing on that, then that is a problem, right? So the guiding principle on this topic is that hybrid resources continue to remain responsible and accountable for meeting all AS requirements, as sort of stated in the tariff, and that any dynamic limit usage must align with those responsibilities and those attestations. So there have been some concepts elsewhere that have been discussed that we've heard from stakeholders that they could help, and we've also seen as ISO staff that they could help mitigate this issue as well, right? So one example is if we did real-time AS reoptimization, right? Another is, changes to the outage management system that could lead to faster turnarounds of outages into into market awards, and they may get to that core ask that we've heard from you all about streamlining the AS service availability reporting and really making sure those AS awards are happening as soon as possible to the outage submission. And with this issue in mind, though, right, we're seeking feedback on whether the ISO is seeking feedback on whether this is something that we see as definitely something that we need to enforce for tariff compliance. And the question is there something else that we're missing here that stakeholders would like us to consider? Is there would stakeholders say, yeah, let's get sort of constraint in here, right, to help mitigate this problem. You know, and in this enforcement, right, you know, is something that is this something that also should be considered in long-term sort of conversations related to, you know, AS reoptimization, and you know, in the meantime, we can kind of continue with this strict enforcement of the tariff, right? And it is just kind of flagging this as a topic for discussion, and you know, kind of seeing where the community is at on this. Okay, with that, any questions, comments? I know I moved a little quick there, but we're happy to take any comments and questions at this time. Otherwise, we'll move to next steps, and we're also happy to take any written feedback or offline communication.
So let me see if there's any questions, and they're not. Please just raise your hand utilizing the WebEx raise hand icon, but I think right now there's none at this time.
Okay, great. Well, thank you very much, everyone. Brendan, I'll pass it on to you for next steps here.
Great, thank you. If Tegan, can you go ahead and thank you so much. So right now, the next steps, we do have a little bit to share. We do plan to submit that comment template this afternoon to get posted. To go over those comments, it will include the discussion for today's meeting, as well as the issue paper straw proposal that we posted last week. And that would include just any feedback from or concerns on anything that with regards to that comment template we're posting. And then we do have upcoming in April a straw proposal posting on outage management, and then uplift, DEB, and state of charge management. More details to come. We will be posting a notice when that does occur. In May, we do have stakeholder meetings scheduled and comments for the straw proposals. That would kind of, we'll let you know on the exact topic for that. And then June, we'll also kind of go over the revised straw proposal posting for uplift and DEB and state of charge management that we posted in April. So heads up for that. And then July, we do have another stakeholder meeting. That one will be sharing later on exactly what will happen in that meeting. But in the meantime, we do invite folks, if they are interested to present topics or presentations from the stakeholder committee, please email me. That would allow us to give us enough time if you want to be added in April, May, or June, or July timeframe for our meetings. And then at this time, I did provide a lot of links in the chat in the very beginning for storage design modeling, but that will be there in case you want to follow up. It's all posted as well. So at this time, the last slide I have to cover will be the Energy Blog Matters. We have posted recently the two new entities that have joined the WEIM in May, and we'll be extending our market footprint on the 12th for the Western states. So that's a great blog to kind of check out how we're doing within the EDAM and WEIM. So that will be a good article to kind of review. But we do have upcoming blogs coming your way to share more information with the latest updates with EDAM and DAME. So that will be really helpful for our community at this time. But at this time, I don't have any more questions in the queue. So we'll go ahead and resume our call at exactly noon. So thanks to everyone for your questions. And we plan to hopefully post a recording within the next 2 to 3 business days. I will have that expedited, so you'll see it much quicker than the last turnaround of our recordings. So Tegan, I would like to invite you to help close our call. Thanks so much, everyone.
That concludes our conference. Thank you for using Inteller Events. You may now disconnect.